So, welcome back to Everything Marketplaces, where we talk with founders and leaders from some of today's top marketplaces. So, this is episode 168, which is really a great group chat that we just had with Colin Gardiner, who's currently a marketplace advisor and investor. Colin was previously the chief product officer and then chief revenue officer at Outdoorsy, which is a leading marketplace for RV rentals. Colin helped grow Outdoorsy to over $3 billion in revenue and raise over $200 million in capital while he was there. So Cole is actually an early group chat guest. This is great to welcome him back on, where we started off with a quick refresher on his background with some of his key learnings from Outdoorsy, where we got to learn more about how he now evaluates marketplaces when investing in them. We discussed lots of topics like the current state of fundraising, some of the mistakes he commonly sees marketplace founders make, opportunities for marketplaces. We also had a great group Q&A. I really enjoyed this conversation, and you're going to find it a great watch to the end. So, Colin, welcome back, and it's been a while. I believe 2 years since you're a past group chat guest. So I'm really excited to have you join us here today, and wanted to start off by saying a huge thanks for taking the time to do so in advance. So we have a lot that we're going to chat about with all of your experience at Outdoorsy and now advising and investing in marketplaces. But before we do, I think it might be great if you're going to start off with a quick refresher on your background for those that have just joined us here and might not know you.
Yeah, I'd love to. And it's good to see some old and new faces here. So I've been doing marketplaces for 15 plus years at this point, and I really started my career actually not in tech marketplaces, but working at the Federal Reserve, studying the U.S. labor market, so the biggest marketplace of them all. Um, and I got into tech, and the first company I worked for was a horizontal marketplace called Just Answer. So it was like a services marketplace. You could ask a doctor, a lawyer, a vet. You could do confession. You could do it all. Still around. And then from there, went to ancestry.com, then another company called tripping.com, then ultimately my most recent experience, which is Outdoorsy. And since leaving Outdoorsy, I've been advising consulting marketplaces for the past couple of years. And more recently launched my own venture fund, specifically focused on pre-seed marketplaces.
No, that's a really great background. So thanks for sharing with us on that. So I wanted to go back to your experience at Outdoorsy, since that's of course a marketplace that we all know of as I believe what the largest marketplace for RV rentals now, and it's also come up in a conversation more regularly with founders. So could you walk us through your experience at Outdoorsy, and then maybe even kind of touch on what you think led it to break through?
Yeah, no, I'd love to go deeper there. I was a early employee, kind of the first executive hire, chief product officer, and then ultimately chief revenue officer for a couple of years. Um, and Outdoorsy, I think at the surface looks very much like a peer-to-peer marketplace, much like others. But I think a lot of what differentiated it was our early strategy, which was peer-to-peer, but an insight around, hey, look, there's people doing this professionally that are, aggregating RVs in some way, whether it's through consignment or had a couple of them themselves, and they were renting them out. And usually in rural places, they didn't have software for them. They're probably running it on not even on a spreadsheet, probably just on a clipboard. And so there was this insight where, hey, we could actually build them a software. They could run their business on it, and then we get all that inventory and we put it on the marketplace. And so that was really the big kernel of that we kind of unlocked, that allowed us to really scale. And so the reason that's really important, and what it's called a SaaS-enabled marketplace, and why it's important is, like, you can go get supply that's already out there doing what you're doing. They're professionalized, so they want to get high utilization rates. They want to sell out. That like they want to be in business and they want to maximize revenue. And what's nice about that is when you distribute that inventory in your marketplace, you're providing a really high quality experience for the demand side. These people want to essentially get their calendars filled, and so the demand side comes in. There's usually instant bookability. There's a lot of availability, and then on top of that, we started layering in the peer-to-peer side.
You mentioned as far as being SaaS enabled. So I guess like what point in time was that for Outdoorsy?
It was a couple years in. I don't know. I remember the exact time frame of it. But pretty early on, it was clear that, like, hey, look, this whole model around just like going on Craigslist and finding people with their RV for rent and trying to get them on like onesie twosies was going to take a long time to scale. And this is like very similar to the Airbnb story, where there was like they needed to figure out some way to scale more quickly, right? And I do liken property managers in their context is probably very similar to the people that we went after with their SaaS software. So, you know, that ultimately allowed them to really scale, is like bring on like huge swaths of inventory.
No, it's definitely a topic that kind of keeps coming up with the founders in the community, thinking about the SaaS-enabled approach and, if and when the right time to do that is. So I guess, on that note, like, how do you, I guess, advise kind of founders, that come to you, when they say, hey, we're taking a SaaS-enabled approach, kind of building a marketplace.
Yeah, I mean, I think for me, the SaaS enabled marketplace concept is really about this, like what I call marketplace plus model. It's like a marketplace plus something else. And the reason you need a plus or don't need it is that you're trying to embed deeper within the supply or the demand side or both, right? And so, the SaaS software in the context of Outdoorsy was really about, hey, can we go deeper in the supply side to give them a reason to run their business on it so that we can have distribution of their inventory? And, by having distribution, you had access to their calendar, their availability, real-time rates, all of that, which is really important in the travel space, right? It's like if you can't instantly book something, it just makes it harder to do. So other spaces are a little bit different on what matters, right? But I do think overall what matters is inventory of some kind and having visibility into it. So a system of record. And so kind of what I suggest to people as a place to start is, hey, if there isn't a really good system of record that you can either integrate into or like can be built, that is like an opportunity for a SaaS software, right? It's really about system of record and getting visibility into rates and availability for the supply side. Now, there's other versions of the SaaS where, you're like, maybe you solve another problem. Maybe it's a compliance problem. Maybe it's payments, like whatever it is, there's some pain point that's really critical to the purchasing cycle that isn't solved. And if you could get that solved, you actually get people onto your platform because that is getting solved. So I've seen a number of different ways, but you can also do it, outside of SaaS, you can do is like a community. I mean, I think that's a big part of, a lot of these businesses, and was part of the playbook at Outdoorsy. It was like we built a big community. You can also do it through like insurtech, fintech, the list goes on. Whatever is your wedge that allows you to get liquidity on the marketplace, do it.
You mentioned a lot of great points. So that already led to a few questions in the chat here. So I know we're gonna have lots of questions around it when we get to the group Q&A. But I guess kind of like looking back now, what were some of your key learnings from Outdoorsy that you've taken with you to now advising and investing in marketplaces?
Oh, I don't even know where to start. There's so many. Uh, I think a lot of what I learned, not just at Outdoorsy, but through, scaling like a few marketplaces and was really on the like the fundraising side and like what it means to storytell and how to articulate how marketplaces work. Because I think one of the biggest problems that I see is that investors, like, ironically, there's not as many sophisticated investors around marketplaces as you might think. And so when you as a founder of a marketplace, that one is very specific to a vertical, but two, you like have all these dynamics that are just a bit different between each of them. It's actually kind of hard to go and like tell your story and articulate your numbers in a way that like makes sense to them. I'm sure probably everyone in this crowd has had some investor that's like, "Hey, what's your ARR?" And you're like, "Oh, you're funny. Um, I don't have recurring revenue. I only have GMV. And so I think that's one of the things I learned a lot was like how to articulate meaningfully marketplaces and to investors. And so that's something I've been helping, like, honestly, the thing I like, it's not my expertise. Like my expertise is in product and growth. Um, but I think I find myself spending more time helping people and founders like articulate how their marketplace works and the numbers that they need and the metrics behind it than I do actually helping them with the specific mechanics. So that would be the number one thing I'd say is like you got to like how to articulate how marketplaces work to investors is really important, and that's something I learned a lot about. And we can go more into that. Uh, the other thing I would say, it's really specific to like B2C marketplaces, is that, you know, at scale for B2C marketplaces to work, they need to be predominantly driven by like organic direct and referral traffic, like upwards of 60 to 80%, right? Like to make the CAC work, you really need a lot of organic traffic or like reason, like retentive stickiness, like video or live stream, like to keep people around so you can drive CAC down. And I think that's one of the things I see a lot of like B2C marketplaces falter on is one, the take rate is really low potentially, or too low. And that they're not doing enough traffic from like organic direct referral sources and they're doing too much paid. And that's fine, like in the early stages, if you can get fundraising to do that. But for in the world where you can't, like you really need to focus very early on getting these flywheels in the business that are organic. Right? They just has to be true because if you're sitting at like a 10% take rate, and like an AOV of anything under $100, it's going to be really hard to scale, like in any paid channel, and even up to $1,000, like AOV, really hard. Um, so what do I tell people like pretty early on is like try to get your take rate up as soon as possible because that's how you're going to fund your business. Um, and two, like really come up with like and focus on how you're going to grow your business organically. And that can be, and when I say organically, it doesn't have to be like organic search. It can be like referral, word of mouth, like so organic social, like whatever that flywheel is, you need to get it set up early because it's much more painful to set it up later.
Those are really great learnings, and you got a lot of head nods here, so I'm sure we'll kind of get into them a little bit more.
Yeah.
So that's also a good transition into advising and investing in marketplaces, which you mentioned. So could you share a little bit more about how you're currently kind of working with marketplaces as far as the advising capacity?
One thing that I know is that there's lots of early stage marketplace founders that need expertise, but they also need money. And so that was the thing that was for me is like advising consulting. I love working. Like I just want to like daily work with like early stage companies. Like that's the fun part. I want you to text me and we figure out your problem. Like that's or find that person to hire or whatever it may be. Like that's fun. Like I really enjoy that. And if I could do that every day for the rest of my life, I'd be a pretty happy camper. Um, but I know like the bigger part there is like, you need traction and fundraising to scale in an adventure world. And so I was like, honestly, like that's where I want to spend my time and energy is helping founders get on that happy path faster. And so fund wise, I also saw that there's really like not a household name around pre-seed marketplace investing. And I really want to set out to like do that. I want to be that fund that people come to with like, hey, I've got early traction. I think that I got this amazing thing that's gonna work, and I want to be able to be there and hopefully be the first check, or be an early check to kind of be a part of that. And then hopefully work, and then I already do work with great funds like Marketplace Capital and things like that to kind of get them to seed, Series A, and the later stages. Um,
We could probably have like an entire conversation on it, but I guess like from a high level, how do you evaluate marketplaces when you're investing in them?
there's a lot, but I'd say early, there's like a few basic things that all investors look at probably regardless of marketplaces, which is like founding team, market, execution, like those things. Like I don't think I'm like really differentiated on. Like I want to invest in people that like want to solve a problem that's keeping them up at night, like all of those basics. But in marketplace specific, I think the things that I really look for um, are, really around product market fit early. And what I mean by that in the context of a marketplace is product market fit for me in marketplaces is transactions, right? Like your job is matching of supply and demand. That's it. Like I don't care what else you do. If you can match supply and demand at scale, you'll win, right? Um, and for me, like a SaaS product, you may have to go fundraise to build the technology, right? For a marketplace, I would say it's really more the opposite. And I think, Mike, you got into this like in a lot of low code ways, right? Like I think that's really the like honestly the path for a lot of people is a spreadsheet, low code. Like how do you get transactions early and prove it out, right? Because I don't think it's required to have like this crazy awesome product um in a marketplace to go get funding. I actually think it'd be more of a red flag if you were like, hey, I need $1 million to build a product to match supply and demand. I'd be like, interesting. Why don't you just see if you can't go out there and do it like, manually right now, and prove to me that you can do it and do it from people you don't know. That's what I kind of use as a rubric. So, and if anyone, so when generally I say when people come to me and they have an idea, I'm like, great, can you go prove it out? Can you get some transactions? So that's one of the things I look for, really early on. Two, I look for this marketplace plus. concept. Like, are you doing a marketplace plus something else? Right? Like that to me is like a really defensible and scalable model. I call this kind of like the Gen 3 of marketplaces. First were horizontal marketplaces like eBay, then vertical ones like Airbnb, Uber, and now realistically to do it like well and at scale, you're probably gonna have to do a marketplace plus model. And that's kind of like what I look for is like, does this founder have some insight into how to do that marketplace plus model in their industry, whether it's SaaS, community, whatever. And so if you looked at anything in my portfolio, all of them have that componentry to it. Um, and I think last but not least, do you have some interesting customer acquisition angle? I think the best investments and some of the best companies I see have novel acquisition strategies in marketplaces, isn't necessarily novel product. Like I really don't think the product innovation landscape has traditionally been what drove marketplace growth, right? It was actually more probably the aggregation of supply and the essentially getting of unique supply on these marketplaces and essentially putting that in front of demand that was like really, pent up. So I think those are some things to think about and what I look at in marketplaces. One other component, if you can find it, that's really awesome. Uh, Amantha, you have this with in the prescription space is like if you can find inventory that is underutilized, right, and bring it online, that's really powerful. Like if you look at homes, Airbnb, Uber, like the black cars, like anything that's underutilized, and if you can bring it online for distribution and that makes it more readily available, that is a really interesting space overall.
So, I guess like more specifically, like because founders are always asking, okay, that sounds great, like, looking for like product market fit, but like how to invest, like, I guess you as an investor, how do you evaluate that typically when it comes to the specific kind of metrics that you look for?
I think early stage, I focus less on take rate and I focus more on GMV. I would say generally like I generally get a little bit concerned if like you have no take rate. You're like, hey, I'm not going to monetize. I just want to get on the platform. I would be like, honestly, that I don't think that's product market fit. Like if you can't charge people, or like maybe you're going to charge them for SaaS. I don't know, but I'm just saying like generally, if you're not charging, it's not product market fit unless your product is free. But like most people's product is not free. So I would say having a take rate is important. How much it is at the early stage, less important to me. And by early stage, I mean like pre-seed, not like by seed stage, you should be pretty like developed in what the market is going to be for your take rate. Maybe even by series A, like you probably should be fairly stationary. It's not moving all over the place. Um, but I look at GMV, like just simple GMV growth. And the reason is that most of the time you're going to be in a market taking and making mode. So realistically, outside of seasonality, you should be like able to have some sequential growth, right? And then you usually by year or two, you're going to have a year over year, and that's what I started to look at is like how are you changing year over year? Because most marketplaces have seasonality. They're not 24/7 like the same volume. And so I think that's one of the things most investors that aren't marketplace investors miss is they're like, why is your December, like, if you're not in e-commerce, like let's say, you're like Outdoorsy, you're in a summer travel business, your December numbers are the lowest of the year, right? Whereas your June, July, and August are awesome, right? But you look over year, December to December, you could see the company's growth, right? And so I think that's a nuance here that I try to look for is like and understand from a first principles perspective is like, what's your seasonality? How does it work? And try to understand that. Because I don't expect you to have sequential growth, right? But it is nice to see early, like in the first year, like you should kind of be growing sequentially until you start to hit some of the seasonality impacts. So I think that's important, one, to understand, but two, also to explain to people, like, what is your business? So I think a lot of people don't do a good job of explaining from a first principles, like how does my business work? I'm the expert. I'm going to tell you how to think about it. People do not do that. They're kind of deferential. So
That's gonna be pretty helpful. So, something else that I wanted to talk about, and this is something that keeps coming up, is founders asking about the current state of fundraising, and if we kind of zoom in at like the pre-seed and seed stages. So, what are you seeing out there as far as the current state of fundraising at those stages?
I like could take more meetings than I know what to do with. Of great companies, I think overall the expectation should be at pre-seed is you finding a lead or anchor that's like of substantial size is probably low probability. That would be my like thing I would tell people is like, if you get one, great. If you don't, doesn't mean anything. Um, because most fundraising at pre-seed is going to be on a safe, right? Like that's just like how it's going to be. And you're not doing a priced round. If you, and like, there's not a requirement to do a price round at pre-seed. And I'd probably suggest not doing it just to avoid legal cost, right? But my main point is like, it's going to be at pre-seed. It's going to be a bit of the party round. So like, just kind of accept that and go like, move fast, get people in on the safe. I like safes because it's rolling. You're not trying to close at a certain point. You just take the money in as you go, right? And that works really well with where you're at. Now, I wouldn't do more than two safes before you go raise a price round, like just because, each safe is done is not like the if they're done in different valuations, like they still the ownership percentage is still like guaranteed in the safe, right? So like don't do too many of them because you will dilute yourself pretty heavily, and they each have anti-dilution clauses. So um my point being is like just expect a party round. If you get a large check, and by a large check I mean like I don't know, 100, 200, like that, anything over that would be a large check to me at pre-seed. Um, if you get one, great. If you don't, just fill it up, and to the extent that you can. And then focus on really getting a good lead at seed. Um, and what I'd say is like, I don't know, I'm seeing a lot of competition at Series A for companies. Like I'm sure Mike has seen this too, is like I'm getting pinged weekly on like who are the good companies coming up. And like we want to meet them now. Not a lot of like like the seed generalist funds. I feel like there's like competition, but it's not the same as at Series A right now, where people want to deploy like two, three, $4 or $5 million checks, right? In like a $10 to $15 million round. Like that's a pretty like high competition area right now. I'd say pre-seed's like pretty wide open. Seed is still very competitive though for companies that have traction. I would say the average company going to a seed round though in my portfolio and just more broadly has like quite a bit of traction compared to where it was 2 to 3 years ago. Like they're going to have millions in revenue. Um, so
Certainly seeing the same on that. So, something else I wanted to ask about is, some of the biggest mistake that you see founders making when fundraising. So, so I guess, so what are some of the common mistakes that you're seeing?
I thought you were going to ask me all the mistakes I've made, and the book is too long. I'd say it's funny as I've been fundraising for my fund, and I wake up some mornings and realize I should take the advice that I give founders because I see myself doing the same thing. So I just want people to know that like you're not alone, like even your best intentions and with the best advice and knowing all of it, like you're not going to do it right, right? Like maybe perception wise, you'll see some people that do it right, but like the point being is like I still make the same mistakes. I'm human, I'm emotional, but I think the thing that I see myself and other people do is you may get emotionally invested in one outcome. And in reality, you need to have many outcomes lined up, right? Like, and you need to be like just brutal about saying this is high likelihood to happen, but if it falls through, what am I doing? And it's likely to fall through because I see this all the time. Term sheets, like people think term sheet is somewhat binding. It is not. It is a non-binding term sheet, right? And like it can fall apart and you need to have backup options, and you need to have backup options until the day like your paperwork is signed, like across all of it. And I say that like, you know, in the best intentions of people. I don't think this is malicious that people are pulling out. It just is, right? The time kills all deals and they do fall apart. And so just be prepared for that. So that's one thing I see a lot of founders doing is like they get something in hand and then they pull their foot off the gas. And in reality, you should be accelerating probably through that. Because what you want to have happen, like ideally, is you get a lead and you oversubscribe that additional amount that you're trying to raise. Like that is like the way you want, like you don't have to, but I'm just saying like that's a nice way to end it, right? Where you can pick and choose who you have on the cap table and you can architect the ownership percentages that make sense to you. That's what I would suggest. Early stage advice on what I see people doing wrong is not having like a really clear story. Like just I see this all the time. It's like there's opportunity. I could boil the ocean. And it's like I just want like the pith, like the very specific, your key core insight that no one else has and your advantage to doing it. that no one else has. And just tell me that and then show me the proof. Right? Like it's really that simple because if you have good pedigree, like not that you need good pedigree, but if you're like a really dedicated person that has shown that like they worked hard in their career and done stuff and like what matters then is like what you're going after and why and how you're going to differentiate. That's the thing I see at pre-seed. I just see a lot of generalized things of like I'm going to disrupt X, Y, or Z thing. And you're like, cool. Like I could make a deck that says that. And like, what's the, like what's the unique insight and really the how that, and like the proof behind it. So that's what I would say to people.
No, I'm glad you mentioned those common mistakes. Hopefully, our founders here can avoid them. So cool. So we're going to get to the group Q&A because I'm already getting lots of messages from founders, and I promised them we save time for that. But right before we do, so are there any specific opportunities that you see for marketplaces right now?
Get your pen and paper out. No, the so the thing that I've been thinking about a lot, um, is one that I kind of told you guys is progression, horizontal to vertical to like this kind of marketplace plus model. And the marketplace plus model I really believe in. Like it's proved out. There's a lot of people that have done it. And I think it's the next generation into, all types of businesses across the spectrum. But the main thing that I have yet to see that I'm looking for is in the AI specific space is like what do we all know is true about marketplaces that we need to get right is matching. And what is one of the best things that AI can do is it can like take tons of information and like codify it into some like easy to read form and give me recommendations. Like we all use Chat GPT for that, right? And I just don't see anyone nailing the new search paradigm with AI. Like if anyone's worked in product development, like it's always been like let's use Elasticsearch with some facets and like that's it. And I think there's a huge opportunity. Like it's happening somewhat in fashion and e-commerce already. There's search engines that have like they call themselves search engines, but they have raised for this specific idea. But that's an opportunity. Like you know, I'm really excited about agents being able to crawl the web and do like really interesting things with them. And I think they'll be big for marketplaces.
Probably have some founders reaching out. I believe we have a few working on that.
Please do. I want to hear about them.
Cool. So we're going to get into the group Q&A. I think we have a familiar face. Amantha, do you want to come on?
Hello. So my question is, so at the pre-seed, if you don't have a lead, and you're raising on a safe, like who or how do you set the valuation cap?
That's a great question. Set it at what you want. No, somewhat. The kind of the way I think about it is like really more of a dilution perspective. You say like, as a founder, how much of the company do I really want to give up? Right. And I know this sounds like a bit backwards, but if you say, hey, I want to do 20% and realistic 20% dilution, and I realistically need $1 million to do what I'm going to do, then that backs out at like a 5 million, right? And I'm not saying that that's like, oh great, like every company is worth $5 million, right? Like if you don't have any traction, I'd say that 5 is probably a good baseline, and that you probably should have a little bit lower cap than that because maybe you're pre-revenue or pre-product. Like I have an art like a little rubric that I put together and we can share afterwards to kind of help with this. But I kind of like just trying to help people anchor. It's like if you need $2 million to do what you need to do and you don't want to dilute more than 20%, then you need to justify to people that you can raise that valuation, right? And so I don't know. I'm just using like that's the way I would think about it from like a framework because it's very hard to like the cap, like as an investor I think of it as the valuation, right? In the sense of like I'm like my mark is like that's the valuation it's going to come at, because ideally if I invest in you and you grow, you're going to raise at a higher valuation and I'm going to come in at that. The downside scenario is and not positive, but maybe you come in at 5 and I have a discount and I get a little bit better, but like that's fundamentally the valuation where I'm saying I'm willing to bet on you to get to at least that and hopefully above it. And so just tempering that to see where people are and like also realizing that it's a negotiation at the end of the day. Like if you have someone that's interested, they're probably going to tell you, I think your valuation is too high, but I'm interested. Like if someone's not like, I think if you came in at like a 15 and you have no product, people will be like, okay, I'm out. Like, I don't like you're being unreasonable. Like, or I'm assuming you're unreasonable and like, I just won't even have a conversation. But if you have like in the ballpark, I'll probably like nibble around the edges. We'll say like, you know what, let's bring it like add bigger discount or maybe, something like that. If people are interested, they'll tell you. I think that's the thing in fundraising. I just, even for myself to remind myself is like, you spend your time convincing people that are already interested, not the people that are skeptical.
That's a great point. Hey, Dimitri, do you want to come on? And then we'll try to get to you, Eddie.
I have a question about experimentation and sort of as you're working with companies that are, early on versus all the way to going public, what's the right thing you need to see before you start investing in product experimentation or in an experimentation platform or also in marketing experimentation?
I mean, I think you should be experimenting from day one, whether you have a formal apparatus around it and want to pay someone like Optimizely or, whatever it may be, to do something like that. That's a bit different. It's more of a budget question. But I would say that like as a company, you should try and instill in your DNA that everything is like a test, right? And that you're trying to learn. And I think it's more about a mindset than it is about like tooling in a certain time. Um, if that makes sense. I think probably around late seed to series A is probably where people have budgets and team sizes and bandwidth to like do that. If I'm just kind of throwing something at the dartboard there, like that's kind of my experience where people would do that. And you have enough people to run a process. But I think you should be doing it culturally anyway earlier, right? And that, because I see a lot of people like early stage, they're like, this is our goal, right? And we need to drive revenue now. And they're like, that's our objective. Here's something we're going to do, right? And they don't really frame it in terms of like, let's actually, all the things we're going to throw at the dartboard, let's try and set them up so that we can get a learning out of it and get that systematically documented. I think that's the thing that sets people apart. And as like an investor, I love getting those things in updates saying like, here's what we tested. Logically, this is why we did this, and it didn't, and this is what we learned, and it didn't work out. Like that to me is like awesome. Like that's what you like want to see. And I'm less concerned about like what platform or tool or whatever it is. I just want to see that you've come up with a hypothesis, you tested it thoroughly, you have a finding. Now we're doing this other thing, right? Or we're doing that thing more because it's working.
Awesome. Thanks. Hey, Eddie, do you want to come on? Saw you raise your hand.
Yeah, thanks, Mike. Colin, good to see you again. How's it going?
Yeah.
I'm curious from the beginning of your investment career how your process or priorities have evolved when evaluating, let's say, pre-seed marketplace companies. And another maybe framework for that is the famous TED Talk with Bill Gross, where he says timing is the number one determinant of a company's success. I'm wondering how you similarly structure probably maybe criteria or yeah.
Yeah, it's a good question. I do think timing matters a lot, especially in like fund cycle. Like I think a lot of the things that founders aren't privy to, and so therefore it can't really appreciate in the same way if you're like running a fund, is that you as a fund kind of promise things to LPs, right? Like I'm selling you this product, like, I'm selling you this cookie, this like sugar cookie with green sprinkles. I need to get you all sugar cookies with green sprinkles, right? And so if someone comes in that's an amazing looking sugar cookie with orange sprinkles, I'm like, I would love that cookie, but it's like, it may not be a fit, And I think that's actually the bigger issue, I'd say, just overall is like that you're just like people are a little bit outside the lines of the product that you sold to people as a like GP to an LP. I know they didn't get at your process question, but I'd say that's often like what gets misconstrued is like, not that I'm not interested and don't have a great business. It's just that isn't a fit. And it's not me just saying it's not a fit to like get out of it. It's just literally like at face value, it's not a fit. Process wise for evaluating companies, like the thing that I'm leaning more and more into as is like going slower and getting to know people better. Like honestly, and I think as a founder and as a GP, I'm telling you this, like I'm getting to know LPs as I go out and fundraise is like take like the sales pressure off of it. Like I know we all have timelines that we want to raise against, but in reality, the less you hard sell and the more you relationship build and are transparent with people, the better it's going to go in the long run. And I know that like people will tell you like have a hard close date, hard charge, do this. Like, I don't think that applies as much in the pre-seed as it does as running a process as you get later stage. Right. I think it's just different and it's a bit more commodity later. Right. Like, and pre-seed, what I think a lot of ways you're going to be raising from friends and family. So those are the bucket of people that already know you and trust you. But as you think of funds that are doing it at that stage, it's going to be a lot of relationship because they're underwriting you and not necessarily your fundamentals because there just isn't enough of it to underwrite, right? You know, I mean, like maybe you have some good nascent numbers that are like, yeah, of course, this is going the right direction. So like I tick that off as like good, but it's really about the founder and getting to know them. And so that's why when people say warm intros matter, like what they're really saying is like people want to vouch for other people so that like we can get more comfortable more quickly. And so that's the thing is I would say is like it's just hard to fast track relationship building and especially in the Zoom world. Like it's just hard. Like I could, you know, like meet someone, you look great, and then I could just forget about you, not because I want to, but just because it was like very ephemeral. Right. And so I think you as the founder have to spend a lot of time following up and being in touch points with people and trying to build the relationship and like also being human about it. Like, you know, funny stuff. I don't know, whatever it may be. So, I don't know. I'm trying to do more longitudinal diligence is what I would call it. Like spending more time getting to know people and their idiosyncrasies, because if I invest, and any investor invests, these are 10-year funds, which probably should be 12 or 14-year funds. So it's a long relationship. So just remember that.
We're going to try to get one last question. Hey, Sam, do you want to come on?
Thanks, Mike. I'll try to make it quick and let you just listen. But strategic investor versus investor. Obviously, right now valuations have changed. Everything's compressed. You know, and I guess sitting in a seat of fighting for your valuation obviously is easier with a strategic versus an investor, and maybe just a little bit of decision tree. You know, going back to take nothing for granted around what the, you know, what's plan B, right? And obviously plan B can be as strategic. So I'll kind of stop there. You kind of know the question.
Yeah, it's a good question. So I do see a lot of companies, they're raising around and they're like, hey, my largest customer or XYZ industry player wants to invest. I highly suggest you don't take money from anyone that you could be conflicted with later. That would be my 2 cents. Unless it's like they're going to give you something that you couldn't otherwise get, you know, like distribution or technology or like, but at the same time, I would say you need to, your funding agreement and your commercial agreement need to be fundamentally separate. And I just tend to see a lot of bad things happen when they're commingled. That's just my experience. I don't know if that's like fully generalizable, but I would just say at an earlier you take money from strategics, the more that you're going to start having to make decisions based on them rather than what you think is best. So it's a luxury. I'm not saying like it's, you know, like money's money at some point if you want to continue with your vision. So like there are trade-offs. But in an ideal world, I'd say strategic money is reducing optionality later rather than increasing it as you might think.
Awesome. Well, that's a great last question. So we're almost out of time here, but you know, thanks for joining us here, Colin. So this is a fun chat. I know last time I felt like we kind of went down the you know, the rabbit hole and pretty deep on insurance, and this time on fundraising. So this is great to you know, to cover fundraising in more detail. You know, I had one last question for you. This is my you know, my parting question, and I guess this is you know, a revision from last time. But if you could go right back to, you know, before you joined Outdoorsy, you know, what would you tell yourself about marketplaces?
I think I would tell myself to be more patient and realize that like when you have a marketplace that's working, it's very hard to see the subtle undercurrent of the network effect in the moment, right? And you'll see glimpses of it, but that it's actually going and that you're probably realistically, if you have a winner here, you're probably a monkey on a rocket ship, and that a lot of the things that you do that you think are working or busy work around it aren't actually as useful as just the basics of driving supply and demand every day. And just remembering that the more you do of that, the more powerful the network effect becomes, and it just compounds over time. And it's like, you know, it's like compounding interest. It's just like, looks like nothing. And then all of a sudden it's something big. And so that's what I remind myself, is just be more patient on it. And what that implication of that is that like investing in channels like organic search or building a brand or all these things, like early stage, just seem insane and crazy and just not fast enough, right, for your burn rate. But if you don't do those things, you may not be able to like scale really well later. And I think that's the thing that I remind myself, is like patient capital, patient about like and deliberate product development and acquisition of supply and demand, just being really patient about it and knowing that that network effect is going to carry you in the long run.
Awesome. That's going to be a great parting advice for founders here. And then last but not least, time for a quick plug. Where can we keep up with you?
I mostly on LinkedIn. I'm on Twitter as well, but yeah, so on LinkedIn and then at Colin Gardiner on Twitter. Those are two places. But I also have at gardnercolin.com, I have a newsletter that I write. I tried to write it monthly, but it's becoming more like semi-annually. But I'm going to be picking up more here. But I'd love to hear, if you drop in there comments on what people want to hear written about and things like that. I really do want to try and share as much knowledge as I can with people so they can build better.
Cool. Well, thanks again for joining us here, Colin. This is once again a really fun chat, and thanks everyone for the questions today.